Hi everyone, welcome back to the channel. Today we're diving into the world of life insurance policies, costs, and settlement options. Whether you're studying for your insurance license or just looking to understand life insurance better, this video is for you. We'll break down complex topics like policy costs, cost comparison methods, viatical settlements, and death benefit options in a way that's easy to understand. Let's get started. 1. Comparing life insurance policy costs. First, let's talk about comparing life insurance policy costs. The cost of a policy isn't just about the premium you pay. It's the difference between what you pay and what you get back. For example, 1. If you pay a premium and receive nothing back, the cost is the premium. 2. If you pay a premium and get something back, like a dividend or cash value, the true cost is less than the premium. So a lower premium doesn't always mean a lower cost policy. To compare policies accurately, we use cost comparative methods. 2. Interest-adjusted net cost method. One of the most common methods is the interest-adjusted net cost method. This method looks at 4 key factors. 1. Premiums. 2. Death benefits. 3. Cash value. 4. Dividends. These factors help us compare policies of the same type. The NAIC, National Association of Insurance Commissioners, requires 2 indexes for policy illustrations. 1. Surrender Cost Index, for policies surrendered for cash value. 2. Net Payment Cost Index, for policies where cash value isn't surrendered. These indexes adjust for the time value of money, meaning money today is more valuable than the same amount in the future, because it can earn interest or be invested. 3. Life Insurance Surrender Cost Index. The Surrender Cost Index calculates the average cost per $1,000 of insurance if the policy is surrendered for its cash value. This is useful if you're planning to surrender the policy in 10 or 20 years. It helps you compare policies based on cash value growth. 4. Net Payment Cost Index. The Net Payment Cost Index is similar but assumes you won't surrender the policy. It's great if you're more concerned about the death benefit than cash value. This index helps you compare future costs if you keep paying premiums. 5. Comparative Interest Rate Method. Next, let's talk about the comparative interest rate method. This method compares permanent life insurance to a buy term and invest the rest strategy. For example, 1. A 30-year-old wants $150,000 in coverage. 2. Option 1. Purchase a whole life policy that costs $2,000 per year. 3. Option 2. Purchase a term life policy that costs $500 per year and invest the remaining $1,500 difference, since $2,500 equals $1,500. The comparative interest rate is the return needed on the investment to match the surrender value of the whole life policy. A higher rate means the permanent policy is more cost-effective. 6. Viatical settlements. Now let's discuss viatical settlements. These allow someone with a chronic or terminal illness to sell their life insurance policy to a third party for a percentage of the face value. The new owner pays the premiums and collects the death benefit. 1. Chronically ill, needs supervision or can't perform daily activities. 2. Terminally ill, not expected to live more than 24 months. Tax laws require the seller to be ill to receive tax-free payments. 7. Life settlements. Similar to viatical settlements, life settlements allow policyholders to sell their policies for more than the cash surrender value, but less than the death benefit. The key difference? The seller doesn't need to be ill. Life settlements are becoming more common and require a licensed broker. 8. Life insurance death benefits. Let's move on to death benefits. When a policyholder dies, the beneficiary receives the death benefit. Settlement options include 1. Lump sum, a single payment. 2. Interest only. The insurer holds the benefit and pays interest to the beneficiary. 3. Fixed amount. Installments of a fixed amount until the benefit is exhausted. 4. Fixed period. Installments over a set period. 5. Life income. Payments for the beneficiary's lifetime. Each option has pros and cons, depending on the beneficiary's needs. 9. Beneficiary qualifications and changes. Finally, let's talk about beneficiaries. A beneficiary can be 1. An individual, e.g. spouse, child. 2. A group, e.g. all siblings. 3. A business, charity, trust, or estate. To change a beneficiary, you can use the filing method, written notice, or the endorsement method, policy amendment. Remember, an irrevocable beneficiary cannot be changed without their consent. And that's it. We've covered everything from policy costs to death benefit options. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more insurance tips. Leave a comment if you have any questions or topics you'd like us to cover next. Thanks for watching, and see you in the next video.